and welcome to the Trade Finance Distribution Initiative podcast, the business community for trade finance institutions and service providers who are unlocking the future of liquid trade finance. I'm Doris Kunanovich. Good to have you here today. Now, off the back of the 2008 financial crisis, there was a spike demand from regulatory bodies to have more independent rating agencies in the market to cater to issuers and investors. Now, our guest today originates from this key regulatory ask. I have the pleasure of speaking with the CEO of ARC Ratings, Oliver Howard, who will be giving insights into the ratings world and how ARC Ratings have in the last 10 years established a stronghold in the market. Oliver, really delighted to have you here.
Thanks for having me, Doris. Great to be on the show.
And can I just use this opportunity to say a big welcome to the TFD Initiative as well, because you're quite recently new members to the team.
No, thank you. It's great to be part of it. I think it's great to see the list of names there, and fantastic to work with everyone. So we're looking forward to contributing to making illiquid liquid.
Absolutely. Delighted to have you. Now, let's kick off with a little bit about you because you do have quite a really fascinating history. Can you give us a little bit of your introduction and your background? Because we know that you are also from the banking world.
Sure. I worked for Barclays for a long time, about 13 years. I guess I've always historically been in debt of some sorts, in its various different forms. I started off in London, and then over time I was lucky enough to move out to India, where I lived for about 4 years, helping work with our franchise there and working a lot with Singapore and Dubai. And then post that opportunity, I then moved to Africa. I was based within Johannesburg, but headed up our kind of wider Africa franchise, again focused on debt and trade and working capital, and that covered all sorts of jurisdictions, all the way as far north as Egypt, and then out into Ghana, Nigeria, Kenya, Uganda, Tanzania, Zambia, Zimbabwe, Botswana, Seychelles, Mauritius, Mozambique. So quite a broad geographic spread, but it was great to get to know the wider investor base and where these assets really come from. Because I think sometimes you can sit in a financial center and not really see where a bag of wheat comes from, or a raw commodity. And I think it was fantastic to be based in those markets and get to know those things a little bit better. And then post that, I then moved back to London and helped work on a trade finance and advisory fund, which was Cabera, and that was a great journey. And then at a certain time, the chairman of ARC rang me up and said, listen, we really want to grow the art business, and it would be great to attract you to the other side of the table. I think I'd spent the best part of 15 years pretty frustrated with rating agencies, that they didn't either understand businesses or understand certain structured finance transactions, or be it trade finance. So I think initially I was a little bit reticent and said, well, it's kind of a really dominant monopolistic market, and what's the difference that we can make? But I joined about 2 years ago, and I think the business has really grown fantastically, and I think we offer a really good alternative view on credit for institutional investors across the structured finance space, and I think that hopefully is very useful for the Trade Finance Initiative, which I think is got a really good aim of kind of adding to the liquidity pools of trade finance as an asset class.
No, absolutely. And you definitely bring a wealth of experience from having been so well traveled and having that first-hand experience all across Asia and Africa. Now, we know that ARC Ratings started in 2013. Can you give us a little bit of insight as to why this business started and who it's directly catering to?
Sure. It was originally started with an aim of bringing kind of an alternative voice, really, to a number of emerging market shareholders, which at the time were Indian, African based, Asian based, and South American based. And really, it was to give an international agency to those local agencies. And I think as we expand as a business, that mandate remains true today. I think we have a lot of analysts working with us who have a wealth of experience from the big three agencies, but clearly bring, with working within an existing framework, bring that expertise, but also an open mind to the transactions that we see across the world today, and also hopefully some some war stories and real life experience of having worked through the various crises which we've all now experienced, whether it be 2008 or indeed some of the supply chain crisis which we saw during COVID. And I think hopefully that offers us an opportunity to learn from that and really make sure that we're delivering to institutional investors in this asset class, which by its very nature should be non-correlative and low risk. And I think now we're getting more and more data to support that. And I think as a rating agency, we can listen to that, adapt our methodologies, and deliver for investors that voice, which is what we're hoping to do.
And this is really interesting. So who are your clients, the core clients that you're looking to work with at the moment?
So the ratings business is always an interesting business because there's inherently a lot of times we're instructed by an issuer, but at the same time we are often instructed by an investor. So actually, from our sides, we wear both sides of the coins, but really what we're trying to offer is an independent opinion on either a company, it could be a financial institution, or in trade finance as an example, an asset class, a structure, whether that be an SPV or a program or something to that effect. And I think at all times, what we're trying to do is give a representative view of the risk that sits in front of us. And I think, therefore, from a client base, we work with both sides. I think our view doesn't change no matter who instructs us, because it's quite key that when we give a view, that view is consistent, in line with our methodologies, and can be valued. So when you look at an art rating and you're rating a receivables program or something, it shouldn't matter whether the end investor may be the one who instructs you, or it may be a bank looking to package up and distribute those receivables. Either side of the coin, the view will be the same. And I think for us, that's what we're trying to give. We're trying to give that transparency of how we look at risk. And risk, I think, in trade finance has not evolved. It's an old business. It's always had the same risks since 1500s. It goes back that far if we really think of trade in its very essence, and really linked into the genesis of money. But I think what we've seen emerge in the last few years is kind of ways of dealings with those risks, and ways of dealings with some of those operational risks in terms of digitizations, platforms, and hopefully getting to the root of some of the key risks and de-risking those. Because I think if we can begin to expand some of the tools which we use, it hopefully is only going to enhance the risk appetite for the asset class itself. And I think clearly there's a number of members who help facilitate that within this initiative.
Now, you've just said something interesting that risk hasn't really changed over the years. So how are ratings kind of used for, like, in traditional investments? Can you give us sort of like an insight as to what the process is for those
Sure.
traditional investments?
So I think what I was trying to comment on is, if we go back to the genesis of trade, and trade is one of the oldest businesses. We're moving goods from one place to another, and I think that really does go back to the core of how countries started to talk to each other. I think clearly a number of things have moved on since then. It goes without saying, but at its core, trade is such a fundamental part of everything that we do from day to day. It's about getting the computer screen from where it was manufactured to what this phone call that I'm having today, and that always will require finance in some shape or form. And clearly the beautiful thing about trade finance as an asset class is you're able to go into certain parts of that process, whether it be supply chain or vendor finance, or whichever part you want to finance along that chain. And essentially it allows you to create structures around that and then apportion risk and reward accordingly. And I think from a ratings perspective, what we try to do is really utilize our methodologies to look at the core risks which sit there, and then what mitigants are brought to bear. That can be documentation in terms of insurances and look through. It can be reserving. It can be a whole bunch of other factors. It will depend on the specific asset class within trade. I think we're lucky and fortunate to have within the team, both on the commercial side and the rating side, people who've rated a number of these instruments over the last 10 to 30 years. On the commercial side, we have Jason Barris, who has 35 years of trade finance experience and really understands trade as an asset class. Myself, I've been involved for many years. And then on the analytical side, we have a wide range of analysts who've worked across a wide range of structures. And I think hopefully that enables us as an agency to give an independent opinion of a structure, which for an investor is key. It's key for a number of reasons, whether it be regulatory, whether it be for their own investment mandate. It can be obviously for the banks itself in terms of their own internal risk models. And I think really we play a key part within this ecosystem, as do other agencies. And with the commodity cycle that we're seeing, and just the nature of evolution within trade, what we're seeing is larger and larger numbers for the same names. Primarily, I mean, you always have new entrants, but primarily banks are faced with a key issue today, which is that trade is very concentrated by volume in not so many names. And at the end of the day, as those numbers go higher and higher, and those names need more and more financing, you're going to hit concentration limits, whether it be by country, counterparty, or indeed asset type. And I think where as an agency we can add real value is by looking at the packaging of those structures and giving a view on the risk which those structures represent. And then clearly there's a margin linked into that. And that then can hopefully bring to bear a whole wealth of other investors who we always have believed would benefit from these assets. They are non-correlative, they are very stable, they are very low risk. And really when we think of, yield curves and when we think of, maturity mismatch, there's always been clearly CP and bond papers and all sorts of other things. But, this is an asset class which is incredibly underrepresented in investors across the book, whether that be a slightly higher yield play or a slightly lower yield play. I think across the book, it's underrepresented when you look at, the money that's out there. And clearly, the more that we can all play a part in this, I think that would be very, very helpful. Because quite simply, we always talk about this trade gap. You log into LinkedIn, you can just see it every single day, but it's real,
It is.
and that has a real life impact. And very simply, if we can improve and close that gap, then the world will be, fundamentally a better place across a number of factors. And I think, when we talk about impact as well, what is more impactful than the goods which we use each day? And I think, trade is also a very neglected asset class in terms of that. It has a massive impact. A classic example, real life example, we would chat to customers and they have goods not being shipped. They have goods going to waste, quite simply, or, things not being grown
Stuck.
because quite simply
Yeah.
stuck, or, essentially commodities not being financed and put into the ground. And those impact communities across the board. They impact communities. They impact the people adding value to those commodities. They impact the people working shipping. It's a very interesting dynamic that we sit in today because we were on a trend of increased globalization, no doubt about it. And with COVID, and then clearly the unfortunate war that we've seen in Ukraine with Russia, there's now this kind of trend towards more localization, or maybe glocal, as we may call it. But in that context, the amount of demand is not going to decrease. That's the nature of growth. So this trade gap will only grow. It just may shift slightly in terms of where the goods are produced and then shipped to. And, in Africa, as an example, the intra-Africa trade agreements are fundamental to that because it makes no sense to, make something, ship it all the way around the world when, you have a neighbor that needs that product just as much. So, and I think within all of these structures, the beautiful thing about trade is that it's one of the asset classes, if you look across them, that is the most standardized.
Yes.
And that is a fantastic thing about this asset class. Once you get to know it, documentation flow, the way in which goods are accepted or rejected, insurance, everything is, you get to know it. And once you get to know it, those things are standardized. So that plays to the platform that, with trade tech, it plays to insurance players, people like ourselves, because if a deal looks different and fundamentally is structured in a weird way, that's not trade. Trade is a very standardized product, and I think from that perspective, we have the experience to look at these instruments and say, right, as an investor, you have concerns about whether that these risks, and is it a low risk asset? We can give that opinion and hopefully give you the comfort either for internal mandate purposes or for regulatory purposes.
Absolutely. I think trade has been happening for hundreds of years, and it's basically been the same process that we've had from times of merchants up till today. So it's pretty much had a great foundation that makes it easier, a little bit easier for platforms and for service providers such as yourselves to kind of see the structure there and kind of work with that flow. So anything else that is opposing to that kind of rings a red flag immediately. Now, if you're still listening, this is the Trade Finance Distribution Initiative podcast, and we still have with us the ARC Ratings CEO, Oliver Howard, talking about the trade finance and ARC Ratings, and obviously adding value to this asset class. Now, in terms of methodology, what is the rating process?
Sure. So you mentioned methodologies there. I think methodologies are in place for all rating agencies to really explain a bit like a recipe for cooking. It gives you a very good idea per asset class how we look at the risks that are in place for that asset class. And our methodology, each rating agency will have their own. We have our methodology in place. I think before we enter into any transaction with a counterparty, we will review that with our analysts, look at the structure, and first of all, decipher, is this a rateable transaction? Because there can be a lot of good transactions out there, but they just fundamentally don't lend themselves to a rating product. And there's nothing wrong with them. It's just that fundamentally the structure itself doesn't lend itself towards attracting a rating. It could work very well in a bank context or an alternative finance context, but because of the way in which it's structured, and that's key when you look at our methodologies, it doesn't maybe isolate some of the risks or allow them in a true securitization sense, which is key to attract the kind of rating which would be very useful for investors. And I think this is the key. I think ratings isn't for every situation. It's for very particular situations, and in trade finance, and it can be very, very useful in those situations. But there will be a whole nother flow of business where ratings really doesn't add value, and I think that's the key here. We have to add value to the process, or otherwise it's just an inhibitor. So from that perspective, we'll engage with our analysts. They will review documentation, they'll review transaction structure, they'll review the counterparties both sides, and also the person bringing the transaction, their skills, experience. From the commercial side, we are then no longer involved once there's a rating contract signed. It is handed over to those analysts, and they take that forward with the customer. In terms of a process, it can take generally between 8 to 12 weeks is what we say. It can be shorter. I think the shortest I've ever seen is 2 to 4 weeks. But generally, it will depend on information flow, also just when people are available for phone calls and things like that. And from that perspective, we will then engage with the customer, run through the transaction, have a number of usually phone calls with them, interactions, and usually we would then feedback where we feel the rating would be coming out at. We would provide the opportunity for them to review our report. And then at that instance, if there are any things that need to be corrected that are anatomically correct, we would do that. And then post that, obviously, the rating would be issued, and it could be a private rating, it could be a public rating. In the world that we sit in today, a lot of institutional investors are moving towards private ratings. That has been a real trend in the non-bank world. So as we've seen a growth in private credit, there's still a huge demand for ratings in a private context. And there can be a number of reasons for that. But, this perception that really ratings are just what you see, on Bloomberg or whatever else it is, I would say that world has grown ginormously in the past 5 to 10 years, particularly, along with private credit itself. So, you've got tens of thousands, maybe hundreds of thousands of private ratings out there, which are usually instructed by the investor. So from our side, we get a lot of investors come to us and say, we would like to invest in this structure, but we would like you to have a look at the structure and, provide a credit rating on it. So we will engage with that issuer, and then we will provide that report. And then, that can be used for internal purposes. It can also be used, in a fund context to help with raising liquidity. That clearly is another example in which, ratings can be used. But in the context of the distribution initiative that we're talking about, it may well be that banks originate a number of assets, package them into, let's say, an SPV of some sorts, and then they may choose to distribute those in a private context as much as a public context, and that may attract a private rating rather than a public rating. Hopefully that gives you some idea of, there's nuances within there, but hopefully that gives you an idea of the overall process.
In terms of your own propositions, I mean, ARC Ratings propositions to originators and investors, what are they? What are your propositions to investors active in trade distribution?
Good question. I think when you look at any asset class, you have to work with an agency of analysts and people who understand that asset class. And I think our proposition is that we speak the language of trade. Uh, we understand pretty much the full life cycle of we have worked in banks, we've worked in institutions on the other side of these transactions, and therefore I think we can add a lot of value in terms of understanding some of the challenges which both issuer and investor face in assessing this asset class. Trade is one of those things that 1,000 transactions can look exactly the same, but then there's that one thing that may or may not be the same, and that can cause massive operational or other risks. And I think we have the experience, and for want of a better word, the battle scars to understand those and to be able to convey those in an opinion on the risk that sits in front of us. I think also another key aspect which value I would say that we add is the larger agencies, and I'll just be honest, they price off a very different structure. And why is that important? The reason why that's particularly important in trade is a lot of the deals that we see distributed into the market are not billion-dollar deals. They tend to be, in my experience, some of those notes are $50 to $100 million within a much larger program. Now, in the context of that, a much higher rating agency fee, makes that transaction uneconomical. Because frankly, it increases the transaction cost on that particular note. Now, for us, that's we have our pricing structures. Other people have their pricing structures. I think we represent great value, and that is quite important. Where you're not talking about billion-dollar transactions, where X thousand here, X thousand there. It's half a bip or a bip on a transaction. On a smaller transaction, it can be tens of bips, and I think that's where as a service provider we can add a lot of value, because it doesn't mean that we provide a less superior product. I think we provide a fantastic service, and we are a very service orientated business. But fundamentally, if trade finance is going to be distributed into a lot more institutional investors, you can't have lawyer, accountant, and legal fees sucking up investment return and rating agency fees. So having a rating agency that that prices for great value and prices very keenly, I think that adds really good competition into the market. And we need to remember that in the rating agency business, you're talking about 3 people having 90% market share. That can't be a good thing, and I think for institutional investors, that's not a good thing, because at the end of the day, it's just natural that, that breeds perhaps a lack of competition and a lack of pricing competition. I would encourage investors to ask themselves the last time that a rating agency fee went down. Ask themselves that. For us, we are here to change that. We are here to provide competitiveness, as are some of the other smaller agencies, and that is a positive thing, because at the end of the day, unless you have that pricing tension, the things will just go up and up. And whether an institutional investor invests in trade or invests in something else, transaction costs are a fundamental part of that return. And I think what we offer here is the ability to rate 5 or 10 notes at a good speed, understanding the asset class with a great level of service at a competitive price. And I think for where the market is tending, which is smaller transactions, more bespoke transactions, and private transactions, I think we add massive value in that space. Whereas I think other people within our space who maybe have bigger brands play somewhere else. But for trade, that's where we've seen a growth. We've seen massive growth in segregated managed accounts, where people are allocating, $100 million to trade, try it out, see how it goes. This is where lawyer fees, accounting fees, trustee fees, you look at what Trade Tech does as well, try to reduce those fees in setup of SPVs. It all goes into that process. I think we can add huge value in there. So a bit of a long answer, but I hope it's been useful from that perspective.
No, absolutely, because I think it's so important to be flexible today. Because with trade finance, there's so many moving bits and bobs, and for a lot of companies now, I think the ability to scale is something that is of crucial value to be able to make the most impact. And I know you just mentioned trade tech in particular. Do you have any synergies with trade tech as a distribution hub?
Sure. I mean, I think trade tech is a platform which enables a number of different functions within trade, whether it be speeding up the trade process, making it more transparent, just bringing together a bunch of actors within the ecosystem. And I think it also plays into that, for want of a better word, more price competitive in terms of it has its own SPVs, it does things properly. And I think that, facilitates a speeding up of distribution of trade finance assets. And that's fantastic. I think for us, where we can play with trade tech and the overall distribution as well, is most of that paper will be distributed into investors, and some of those investors will want an independent opinion on it. And that can, as we said, that can be for regulatory reasons. It can not be for regulatory reasons. But as an agency, we're ECI certified, so that means that we carry the same regulatory weight that other larger agencies do. And that's pretty important. So, when you're looking at capital charges, we would rating would count for the same things. So, in that context, so I think working with trade tech, who are bringing together and packaging together trade assets into digestible format for institutional investors, those institutional investors, some of them would then like an opinion on that, and I think that's where ARC can add value by being service orientated, being efficient in how we provide ratings, and hopefully being cost competitive, which means that for transactions where investors want to keep their costs down and keep their returns to themselves, we can be competitive and fair and hopefully offer value. But I think we all have a part to play in this. At the end of the day, sadly, we've seen a number of digital trade platforms shut down in the past, 6 months, and we should talk about that. But that doesn't mean that the demand isn't there. It just means that I often think timing is a thing, but actually the demand is there. There's never been any doubt, or there shouldn't be any doubt, that the demand is there. It's just about having the right digital platforms in the right place at the right time, which help facilitate the flow of an asset class from one place to where it's well received. And key is at a cost that it's well received. And I think when you add all of those things in, I think hopefully this initiative can help continue the important work which it's doing. Because trade finance needs more digitization, not less digitization. And I think trade tech play a key part in that.
Amazing. I think it's super important as well, because we've seen, like, this year, the talk about digitization, the talk about interoperability, the talk about adoption of technology, new technology for financial institutions is skyrocketed, and I think it's, as you said, there's a huge demand. It's not going anywhere. It's just going to take the person with the right set of ingredients at the right time to really make it work, and obviously everyone play a crucial part to adding value, and really decreasing this gap in trade finance. Oliver, I'm afraid this is the time that we have on the show. I've really
No, that's
enjoyed
been
speaking
great.
with you today.
Excellent. It's been great to be on the program, and look forward to working with everyone to push things forward. So thank you very much for your time as well.
Thank you so much for coming on the Trade Finance Distribution Initiative podcast. Now, for all our guests out there who've been listening in, don't forget you can join the conversation on our YouTube page and subscribe on all our various channels to stay in the loop. My name is Doris Kilinovich. Thank you so much for listening in today. Till next time, have a lovely day.